Hello everyone and welcome to this video. In this video we will understand one important thing, that revenue is the most crucial and most important part of the preparing financial model. When you prepare financial model of different companies, except revenue, most of the items, let's say 70% of the items other than revenue, will be forecasted in similar pattern. Like we have working capital items, dividend, income statement items of expenses or other incomes, capital expenditure, depreciation schedule. They are slight similar. I'm not saying same, but they are similar. 70% of the items in different companies will be similar. But when it comes to forecasting the revenue is definitely forecasted in different ways for every company. Revenue forecasting procedure or the schedule of revenue forecasting is not going to be same of auto sector company with the steel company. Okay, every company has different business, so revenue is forecasted for hotel in a different way, revenue for steel company, cement company, auto sector company, or oil and gas company, uh, any manufacturing company, any service company, IT company, some software company, some chip making company. For revenue model for every company will be different. But other items of income statement, balance sheet or cash flow statement, or let's say 70% items of income, balance sheet, cash flow other than income, other than revenue, are forecasted in a similar way only, right? Every company will have different items of expenses. Every company will have few items which are not common in income statement or balance sheet. Okay, now what I'm trying to say, revenue will always be different for every company. Let it be different sector, revenue forecasting will be different. Let it be even the same sector, even then the revenue for will be forecasted little differently at least. But expenses, working capital, balance sheet items are similarly forecasted. Okay, if you understand how I am preparing the financial model for this company, most of the things can be replicated for other companies also except revenue. I have said this thing in different words, different sentences in this video. Now let me tell you one more point. What I want to say, when you want to forecast revenue of the company, you should forecast the revenue based on the segments, based on the products, based on geographical bifurcation. Now, how you can forecast the revenue? That will depend the way company has provided its data in its annual report. The way company gives its data in its annual report, you have to follow only that pattern to forecast the revenue. Because if the data is not provided in a way that you wanted to have, then you cannot forecast the revenue. You have to follow the pattern, the way company has given its data. Okay, just to prove my point, video can be longer, so please stay connected with me. Let's talk about IB Institute. Okay, if I tell you that my revenue of IB Institute is 100, 150, and let's say 175. These are the revenues of 2018, then 2019, and then 2020. You have to forecast for next 5 years. What is the maximum thing that you can do? If this is the data which I am giving you, you can maximum calculate the growth rate or CAGR in the last 3 years. Based on that, you can forecast for next 5 years. Clear? That's one way. Now, second way. This time I am giving you my sales with bifurcation. Total sales will be this much only, but I am giving you bifurcation like online sales and face-to-face classes. This is something which I'm with this video, I'm just trying to prove only one point, that the way company provides its segments, only based on that you can forecast the revenue of the company. So here what I'm saying, that online sales or online fees for online classes is 75, and for face to face it is 100. Then similarly, like 70 here and 80 here, then 60 here, or let's say 40 here or 60 here. So total is same, but this time I am giving you little more information about the bifurcation of my revenue. Now what you can do, you can forecast your revenue with bifurcation. You can see the growth rate here and the growth rate in online classes, and you can forecast both the items separately and then calculate total sales of next 5 years. If you are not getting my point, watch the video again and then understand the concept. Now if I, let's suppose, give little more bifurcations or more information about my online sales and my face-to-face classes. This is the third way which I am giving you. For face-to-face class, let's say there are two sections. Public classes where anyone can come and attend the class, and college and company trainings. I am giving you this information, that out of this 100 rupees, uh, 40 rupees are coming from public classes and 60 rupees of revenue is coming from college training. So I'm giving you more bifurcations, right? And here if you check out, that I'm giving you information like fees per student is 10 rupees or $10 or whatever. Then number of admission you can calculate, like total fees is 75 and per student I'm charging 10, so 7, let's say 7.5 will be the number of students, or 75 may be the students. Clear? I think you are getting my point, that now what you can do, this item should be forecasted. How? You should first forecast fees per student for next 5-6 years, then number of admissions for next 5 years. Let's say I'll be able to add more students. Okay, then these will be my number of students or number of admissions, number of students who will be taking the online classes, online videos. Then how much is going to my online revenue, fees per student and number of students. Just understand the concept. Okay, I'll be summarizing it at the end of this video. Now this is the main point which you will have to add. Just a second. Now come here. So for public classes, how much we are able to generate the revenue? 30 here and 50 here. Let's say 25 here and 35 here. Okay. Now what you can do, you can calculate the growth rate in public classes, and based on the growth rate you can forecast the revenue for next 5 years, and do the same thing for college and company trainings. You can calculate uh, how much revenue annually or monthly or quarterly we are getting from public trainings, and then forecast these two items and then calculate face-to-face classes revenue from face-to-face class. So let me just assume that this will be our revenue. I'm not teaching you forecasting pattern or means formulas right now. I'm just trying to build up a concept which we will be using in the next videos onwards. So these are, let's suppose, our revenues from these two segments. So total will be this plus this. So this will be my total revenue from face-to-face class. Okay. Now, what will be my total annual sales for next 5 years? Equal to online revenue plus the revenue from face-to-face class. Okay. Now my question from you is, what do you think is the best way to forecast the revenue of IB Institute? Would you like to forecast the revenue based on this segment only, like I'm telling you only 175 revenue is coming, and what you will do, simply put up some growth rate like 10% of growth rate and forecast the revenue. You do not have any proper justification on what basis this total revenue will be coming. Okay, definitely not recommended. This method is definitely not recommended. Now, in this case, yes, you have some justification that whatever total revenue is coming, then this much of revenue is coming from online classes or online video sales, and this much is coming from face-to-face class. So if you increase this also with some percentage, let's say 10% only, you just calculated how much growth rate was there in last 3 years, and then you took up the assumption for 10% for next 5 years, and you forecasted online sales and sales from face-to-face classes. So this is going to be your revenue, this plus this. So my question, I'm leaving this question to you. What do you think is the best way? The first one, second one, or this third one? I will definitely say this third way of preparing the revenue schedule is more justifiable. You have many factors which you can play with and increase your revenue. You can see what particular segment of the business can be improved more, which particular segment has more revenue potential. You can check that, and you can see the impact of that particular segment on your final revenue or your final profit or your final cash flows. So with this particular statement, I'm closing this, coming to this conclusion. Revenue will be forecasted based on the segments, based on the data the company has provided you. If company provides you only this much of data, then you have to follow this process only. If the company provides you only some basic segments, then you have to proceed with those segments. If company gives you more data of its segment, then you can dive deeper into its revenue segments and play with the data, analyze the data, and create a robust dynamic revenue model for that company. And that third method, dynamic segment based revenue projection, are always recommended and they are always justifiable. Now let me take you to the annual report of the company. So this is your Kellogg's company, the company for which we are making the model. This company says that we have total revenue of 3584. Now this total revenue is coming from these four geographical locations: North America, Europe, Latin America, and EMEA. Okay, these are the four segments. Company does provide you some more information. We will come to that when we actually talk about how do you forecast the revenue of this company. So just pay attention to this. So Kellogg's model will actually forecast it based on these segments only. Let me take you to the Apache model, which is an oil and gas company. Now here what it says, that total revenue is coming from two segments. One is production multiplied by the average price. Okay, it has got three different products: oil, natural gas liquid, and natural gas. Production base company further gives us details about its geographical bifurcation. So oil production is coming from these three geographies: United States, Egypt, and North Sea. NGL is also coming from these three locations. Gas is also coming from these three locations. So we actually have 3 years of historical production details for all the three products, for all the three geographies. And we also have the different prices for all the three geographical location for all the three products. Now this company's model will be prepared based on this data. I'm just trying to show you that revenue will be forecasted differently for different companies. Now let me take you to another company. So this is your Netflix model. Now this company says that company has four different geographies. There are so many countries, but how it has segmented its revenue? It says we are getting revenue from United States and Canada, Europe, Middle East, and Africa, it's EMEA, then Latin America, and then Asia Pacific. And how revenue is coming from these geographical location, it has given us some information. What are the information? It says that uh, revenue is this much from United States and Canada, and this revenue is coming by multiplying average monthly revenue per member with total number of active members. So this is the revenue which you will be getting. So what we have to do, if we have to prepare the model for this company, we actually have to forecast these four items, then this total revenue will be the outcome. Okay, so we actually have to prepare the four segments which are given here: United States, uh, Europe, Middle East and Africa, Latin America, and Middle Asia Pacific. So we will actually be forecasting these four items for all the four geographies. So here I have given you three examples for three different companies. I can definitely take more examples, but I just wanted to prove my point that projection parameter, projection criteria will be different for all the different companies. Specifically, this particular statement applies to revenue. For expenses, for balance sheet, for cash flow statement items are 70% same, which you will be able to understand within this particular financial model. The 30% items which are different in different companies, that will be a lifetime journey which you will have to keep on learning. If you want to understand the model, how do you prepare for Apache company's financial model, or this Netflix financial model, or real estate financial model, Colgate financial model, Tata Motors financial model, or this Kellogg's financial model, you have to actually go to that particular segment where these videos have been uploaded and watch the videos there. In this video I just wanted to show you, and I just wanted to prove only one point which I have proved, I think. Okay, so now in the next video, let us understand how do we start forecasting the revenue of Kellogg's company. So thanks for watching. I'll see you in the next video.